Good morning. Today I will be making a requested video on order blocks and seasonal tendencies. I will begin with the more technical side of things, which in this case is the order block. ICT Michael J. Huddleston himself hasn't necessarily taught the order block theory yet. He says it himself that he hasn't made a video specifically defining what an order block is and showing us examples of order blocks. But he has, from time to time, explained what an order block is. If I'm not mistaken, he did define it as the state in the delivery of price, meaning it's when price is changing from one character to another. When he defined it as this, I actually thought to myself that there's a similar concept from that definition that he has also taught, which is a market structure shift or a shift in market structure. When, for example, we're moving from sells to buys or from buys to sells, right? When we're moving from being bullish to bearish or from bearish to bullish. So that's a shift in market structure. That sounds similar to a state in the change of delivery. That sounds similar to that. So I keyed into it and told myself that it might play a critical role when I'm dealing with market structure shifts, and maybe I don't have to necessarily enter with a fair value gap. I could possibly enter with an order block if I can perfectly understand what an order block is. So the traditional market structure shifts we know is, say for example, price was running up at this point and then went low, failed to make a new high, and then fell off from there. So we could all agree that at this point we had a shift in market structure. We can agree at this point price has changed from being bullish to bearish for whatever reason, right? And we have a tiny fair value gap sitting right there from this candlestick's low to this candlestick's high. There's a small fair value gap sitting there, and the trade would have been to take an entry from the entry of that fair value gap and stop loss being at the high, targeting the next sell side liquidity, which is these lows here. So this would have been the typical 2022 model that he teaches on his YouTube channel for free, which you guys can check out. I'll probably put all the links in the description of this video for my sources. So we have this being the typical 2022 model. But from that definition, I was now able to decipher or break down my best possible view of what an order block is. The second definition that you'd get out there, and from his examples, is that it's an area where smart money might use to reaccumulate their positions. So let's say, for example, we're going up, we had a market structure shift at this point, and now we're falling off. How does smart money reaccumulate orders? Look at this piece of price action here. Why did we not have consecutive red candlesticks? Why did we not have consecutive bearish candlesticks? Why did there have to be a two green candlesticks? They were bullish for these two. In this case, this is a weekly chart. I mean, this is a daily chart. So for these 2 days, they were bullish because even though we were targeting this sell side liquidity residing at this low, they left this intentionally because they wanted to revisit this area and accumulate more orders. So you can see when price traded lower, we came back in this area and then continued falling off from there. So using those two definitions, the first one being a change in the state of delivery, and an area of reaccumulation of orders, I was now able to break down my feel or my definition of what an order block is. So for those that don't really know how a market structure shift is valid, let me quickly break that down before we proceed. So assuming you had a candle print with this, a candlestick pattern print in a shape like so, or another one printed like so. In this case, I just wanted to show the basic structure of a swing high or a swing low. Michael has taught that a swing high or a swing low just needs 3 candlesticks. In this case, we can easily see that this is a swing high at this point, and this is a swing low. It does not matter how far down this candle may be, or how far up it may be. At the end of the day, a swing high is still a swing high for as long as the middle candle is higher than the 2 shoulders, if you want to call it that in quotes. These would be the shoulders of this structure. In the same way, this does not matter if it's literally almost the same as the low, but this low is still lower than this, and this. So this makes this a valid swing low. It could also be something like so. It's still a swing low because we have this sort of shape, this cup shape and this cap shape. So this is a swing high and this is a swing low. It doesn't matter what the pattern may look like, but the definition is that the 2 candles left and right of it determines whether it's a high, a swing high, or a swing low. We could also have something like this. This becomes a swing low as well, just because this low is lower than this 2. This here is not a swing high because this shoulder is higher than it, including this one, obviously by a few pips, but still. So this is a swing high and a swing low, right? I have to give that basic information for the next part of it. So a market structure shift happens when a swing high has been taken. Using the same piece of price action that I used earlier, we can clearly see that this is a valid swing low. The fact that this candlestick is lower and this one is also lower, this makes this a valid swing low. So when a swing low has been taken and very critical, and the candle closes below that level, then we can consider that a market structure shift. Well, according to how I trade. So that's what makes this a valid market structure shift. Now that we know essentially what a market structure shift is, and I believe by now, if you've been watching the videos on this channel, you also know what a fair value gap is. But in this case, we won't be worried about the entry of a fair value gap. So we've covered how you would have caught this sell position using a fair value gap, and Michael teaches us to put our stop loss at the 3rd candle that made the fair value gap. Remember, it's 1, 2, and 3 candles that made this fair value gap. Our stop loss placement would be here. Now let's move on to an order block. I believe a practical example of how an order block forms will be the best way to teach this. We actually have an example here, but I'm not going to look at that. So let's play price. Let's play this. Okay, so we obviously saw that price was tanking the whole time, consecutive days just falling off, and at this point we had a pushback. Okay, we created a swing low at this point and we going up, but maybe we are not convinced, maybe for some reason we're not convinced that this is actually a market structure shift, that we are actually going back to where we started. Maybe you may be thinking to yourself, well, I see myself a big fair value gap in the form of a sell side inefficiency or a CB, right? Maybe this will support lower prices from here, right? And that would be a valid point, especially considering the fact that we closed this sell side inefficiency to the pip. You would think maybe it's time to finally sell off, and that's not there's nothing wrong with that view. But let's say you are looking for buying opportunities for longs, right? Remember how I pointed out why did smart money print these two candles? In this case, we were green the whole time, and suddenly we have two red candles. Of course, this can also be one candle, it doesn't matter, but the point is that there's a random candle with a different color. Why didn't they just continue rallying up? Remember what I said, it's a point where they might be looking to reaccumulate orders. So let's see how price prints. So we had a deeper fall into this fair value gap and rejected immediately above it. I know this might be a bit difficult for many people to spot, but recognize and realize that we just created a swing high at this point, and in fact a valid market structure shift, because the candle of this body closed above this swing high. We can clearly see that we closed above the swing high. So in my book, I would consider this a valid market structure shift. And where this, in this case, of course, we have a reinforcing factor, a reinforcing reason, because we even rejected from a buy side imbalance sitting at that point. So a fair value gap in the form of a buy side imbalance, sell side inefficiency. So we came to it, rejected immediately off of it, and closed above these two candles. So to me, this is what you might call the 2022 model, where a previous low was swept, this low or even this low was swept. We got a move to the upside, creating a market structure shift. At this point, you would have been looking for an entry to come back into a fair value gap of some sort to buy it up, right? But in this case, we don't even have a fair value gap yet, but we have an order block. An order block is essentially these two candles, but let's say the last down close candle before an impulsive move to the upside is this one, right? The reason I'm considering the both of them is because it created a market structure shift. But if it was just one, I would have been looking at this whole candle to be my order block. The next part I wanted to emphasize is the most sensitive part. This is key for anybody looking to learning order blocks and writing their own notes. The most sensitive part of an order block is the wick to body. This gap, this space, is what makes an order block powerful in my book. So let's say you are looking at the last down close candle, but you're not sure because of this swing high, right? So let's also look at this one at the same time. So these 2 points is what we would consider our order block entries, right? Let's label that. It's a bullish order block, of course, because we're looking to buy. So when price comes to any of these two, we will look to enter our buying entries. We don't have a fair value gap, right? But we have an order block. The next part of an order block is that when you place in your stop loss, it's ideal to place your stop loss at the low of the order block, not necessarily the swing low of the whole move. So my stop loss would have been placed at this low, obviously targeting those highs, right? Because I've assumed that smart money has taken out sell side that they wanted to take out. It has rejected. There's no reason for it to come back to these levels here. So I'll put my stop loss at that low. Now let's see how price might print. Perfect. Literally the next day, we tagged not only the first one, but also the second one. And some people might be looking for the body exactly on the body, and maybe they're looking for it on this candlestick and they would not have caught it, because in this case you can see we immediately opened the next day, came back to both of them. We didn't even spend time to come back another day. Came back to both of them the next day, tagged our entries, our stop loss is here, and now let's see if we can be profitable in this trade. Price came the third day, tested it one more time, and started running from there. We came back a bit, still haven't tagged our stop loss at this point. It seems to be consolidating at this point, it's squeezing, but it makes sense because we have a CB sitting there. We're printing higher prices very slowly, and finally took buy side liquidity at that point. So our take profit would have been hit at this point. So that is essentially what an order block is. A change in the state of delivery because you saw a market structure shift happen, right? And an area where smart money can reaccumulate their orders. Of course, everything I said here, this was a bullish example. The same is the case for a bearish example. I'm not going to go through an entire scenario of a bearish example of an order block. So let me clear these for now. And that's essentially the first part, which is what an order block is in my books, in my definition. The second part of this video would be seasonal tendencies. The one trusted place that ICT recommends is this website. It's called Monroe Research Center. They have the best seasonal tendency charts. Of course, you can see over there it's $49 a month, and if you don't like it, I believe you can get a refund. So this is the one place I would say, the one trusted place even I can give full recommendation for when looking for the best seasonal tendency charts. I decided to go straight on to the website where you can get the seasonal tendency charts. But if you don't have the money, or you're just looking to do a bit of research and you don't have the funds, of course, firstly, that's a problem because this industry as a whole needs money. But you can always look up online different seasonal tendency charts. For example, you can look up DXY seasonal. You can look up something like the dollar index seasonal tendency. Of course, you might get a lot from different people, and that might be the way you go about it. You might get different seasonal tendency charts from all of them and then compare to see which one says the same thing across the board. You've gotten that one, and let's say you go to the next site and you also get this one. Of course, see the full thing to assist you better. You might get another one from bar chart. You might get different seasonal tendency charts from everywhere just to see which one says the same thing on the same month every single year and all that. Of course, as I said already, the one place I can trust and would recommend is Monroe Research. They have the best seasonal tendency, but let's just work with one off the internet for the sake of following the example. In this case, we have the US dollar index seasonality. So we can see this whole chart essentially shows, of course, in this case, it's the 20-year average, right? So this shows in a span of 20 years of data, I believe from 2000, because this was generated in 2022. So in a span of 20 years of gathering data, this is the average of how the dollar index has moved. Let's say, for example, in August, we can clearly see that from the beginning of August, we were rallying up until the end, and then somewhere in September, after the first week or so, we tanked down a bit towards the end of September. So I believe this is about the 20th of September. Then at the end, we spiked up again, right? Of course, a seasonal tendency is not something to follow religiously, as if there's no other as if this is the holy grail, that there's nothing else you could possibly need besides this. This is an extra confluence along with interest rates and COT data. Before going to the charts, COT data, I'm probably going to cover it in another video, but if you check the previous video I made, I believe I also covered COT data there. But if I didn't, I'll probably make a different video for that. In the meantime, we can see in August we expected a bit of up move, right? Going back to the chart on the dollar index, let's see where August begins. This is the 1st of August. So if, say, you've missed all of this, you've missed the market structure shift that I defined or all that, at this point, when you got the dip below this price, this tailless candle, this could be used as your liquidity entry for those that are trading liquidity, which is another separate video that I could make one day. But you could have this as your tailless entry because you know seasonally that we're going to see bullish prices in the month of August. Of course, August has already ended at this point. Let's see how price printed the remainder of August. Actually, we got a continued move higher, an even stronger move, and then the month closed. So yeah, we can see that in this month of August we did have the up move that the seasonal tendency charts would suggest. Of course, you don't just enter blindly. As I said, you use it as a confluence to add add to your other analysis, from interest rates to COT, then finally technical analysis. And it allows you to anticipate what to expect the next season or the next coming days or the next coming weeks. For example, it says here in September that we are expecting a down move, but September has begun and we've only been seeing nothing but bullish prices. This might indicate or signal that we may see lower prices in the dollar index soon. Might not be a full reversal to take out August's low, but might be a pullback into a high time frame PDRA for higher prices the remainder of the year, as we can see November being the most bullish, the strongest move the dollar has. So let's go to the chart and see if we could possibly see something like this, a possible down move for September. Removing replay mode and moving to current price. We can see right now that we are approaching this volume imbalance, which was actually a new day opening gap once upon a time. So we have this volume imbalance, pull to the right, we are approaching it next, and I believe that's the next draw in liquidity, a closure of this volume imbalance. And if this happens by Friday, which is tomorrow, we may see a possible pushback down, an aggressive one, into the range, possibly to this fair value gap, this daily fair value gap from this candlestick's high to this candlestick's low. So Friday might see a pushback down into this and maybe continuation to the upside from there, or we may continue seeing bullish prices until buy side liquidity is swept, but on a high time frame due to seasonal tendencies. We may see price wanting to retrace back aggressively. We may have, because week after week after week after week after week we've been getting bullish closures, been getting green candles. So we might get one of those weeks that will actually give us a bearish closure, probably going to be next week actually, where we trade back down into the consequent encroachment of this tail, this specific candlestick. Cut it in half, get the half of the tail, we might get a bearish closure to the tail of this candle, and then a continuation to the upside from there towards the end of September. So of course, as I said, you can't just follow seasonal tendencies to the tick because anything is to be expected, but that's what I'm looking to see happen in the coming weeks. And I believe and pray and hope that this video brings up some clarity on what order blocks are and what seasonal tendencies are. Just a quick way to round up in the next few seconds, I would also consider this to be an order block. So market makers might come back to this level and use this order block to reaccumulate more orders to the upside. Of course, there's also a fair value gap, but I would look at this as well, or even this swing high. Looking at this swing high with these 3 red candles, pull this high to the left, and remember what I told you about the wick to body being the most sensitive parts. So you could find them, test this wick, and then push higher. I know that probably didn't make much sense because I was not illustrating, but there's already too many things happening on my chart right now, so hopefully following the cursor helped. In any case, enjoy the rest of your day, good luck and good trading.